Brokers Digest, a webcast series by The Edge Singapore, discovering market opportunities with you. This episode is sponsored by Phillip Futures.
Hello and welcome back to another episode of The Edge Singapore's Brokers Digest with me, Amala Balakrishna. Over the past few weeks, there has been quite a bit of buzz over oil prices. Inventory levels have been getting drawn down as demand goes up. As such, oil prices posted their biggest weekly gain since mid-March, with the international benchmark Brent crude and the West Texas Intermediate each gaining 7% to trade above $60 a barrel in the week that ended 16th April. Besides oil, other commodities performed well too. The Bloomberg Commodity Index nearly reached its multi-year high seen in February last week. So joining me today to break down these movements is commodities expert Avtar Sandhu from Phillip Futures. Hi Avtar, welcome to the show.
Hi Amala, very glad to be on the show.
Thank you for joining us, Avtar. So Avtar, what a stellar week the commodities market had last week. Does this performance take you by surprise?
Not this time around. You see, the buzzword now has been commodities, and the high or rather fast appreciation of prices in whole range of commodities. So this time around, actually, I wasn't taken by surprise itself because it was something that was not unexpected. Had this been had this thing happened maybe at the same time a year ago, it would have been a really reorientation of your thoughts and your views on commodities. But this time around, it is something different.
Right. So after market watchers are saying that buying commodities is an effective tool to hedge inflation risk. So as US President Biden injects more liquidity into the market, inflation is expected to pick up. So would you say that this is now a good time to invest in commodities?
So now the talk has been about the emergence of the commodity super cycle. A super cycle is just not a post-COVID rally or something like that cause all the prices to go up. It's actually a sustained period where prices go up for a long period of time. If you look at the chart itself, right, you find that most commodities are in what you call, what in technical terms we call backwardation. That means the front months are much higher than the back months. So what we have is, even the technicals are showing that if it has been the other way around, a lot of people would have felt differently. But most commodities have this particular shape in their forward curve, which implies that most investors who want to jump into the market currently rather than wait itself. Then we have the other commodities also going up as part of the super cycle. History tells us that super cycle comes every few years. In the last century, we had about 4 or 5 super cycles. The last one was ended in 2008 by the financial crisis. This time around, we are in the midst of another one where prices are starting to appreciate at a quite fast rate. And I'm not saying that all commodities are going to go up, but the ones that would be affected by current situation. You know that the reflation trade has woken up a number of fund managers that have actually neglected commodities, in a sense that they look at it and said, because of the reflation trade, I want to be in commodities. So all of them are actually jumping in at the same time and looking at commodities after some time.
Yeah, I noticed that one particular commodity that investors and market watchers have been quite bullish on is crude oil. And one thing I saw last week was that the crude oil prices have been, there's slightly more optimism on it ever since the Organization of Petroleum Exporting Countries, or OPEC, recently released its monthly oil market report, stating a possible 6% increase in global oil demand to an average of 96.5 million barrels per day this year. And similarly, the International Energy Agency also announced its expectations that global oil demand will grow by 6.3% to hit 96.7 million barrels per day this year. So it's also, I understand, an improvement from its previous forecast and follows the better economic conditions and the market that we have right now. So on one hand, this paints a very rosy outlook for crude oil in particular. But after, my question to you really is, how will these forecasts influence the prices of crude oil specifically?
Well, when you look at crude oil or any other analyst that would look at crude oil, they would look at the fundamentals that actually drive crude oil plus the commodities itself. If you look at crude oil itself, there are a number of factors that actually drive crude oil. If you look at the slide, we have one, the supply, the demand side, and we have inventories that one has to consider when looking at crude oil. On the supply side, we have OPEC, that is the Organization of Petroleum Countries, and those out of it. So non-OPEC would primarily be the shale producers and many other countries. OPEC has a new ally now, which we call OPEC Plus, which this organization has reined in to manage crude oil prices. Then we look at the financial market, which are basically traders that have their pie in crude oil itself. Then there is this demand side of the story where who uses crude oil. We look at the OECD countries. We look at the non-OECD countries also, like China itself. Then we also look at the inventories that we have in crude oil. What's the balance? When we talk about balance in crude oil, it means whether the supply and the demand side are equally in sync. If the one side is, for example, if OPEC is producing more, then we have the supply side having dominance. But so far, what the EIA report has said that next half, we will have a balanced market in the sense that the overhang of inventories from the COVID era, or rather what we had from last year would balance itself. Countries are picking up from the COVID pandemic, and most of them are emerging out, and OPEC has more discipline in managing the markets from the supply side. And all this will, in the end, drive crude oil.
So after now that we have a comprehensive understanding of how the price of crude is arrived at, how would you suggest our investors can decide whether or not to invest in this commodity?
Yes, actually, to invest in commodities, if you look at it, it's mind-boggling, because if you invest in crude oil, you don't want a whole tank full of oil in your backyard, nor would you want, say, a whole container of rubber parked somewhere where you feel it is safe, or you want to invest in corn, then you have bushels and bushels of corn in your backyard, or even soya beans itself. Okay, one way people do it is for investors. They don't go directly into what you call the commodity itself. Most of them actually try and understand how they can get into futures itself. There are many ways of getting into futures. Of course, one would have basically a brokerage account with a broker itself. So the other one is to understand the whole concept of futures contracts. Futures contracts are primarily derivatives they derive their value from, let's say, the WTI intermediate Western crude that is traded on CME. It derives its value from the underlying crude oil itself. So if one wants to jump in, he can look at these futures contracts. The thing they need to do is to understand the benefits and, of course, the risk that is involved in futures contracts. I talk about risk itself because futures contracts are primarily traded on margin. What it means is that you have a much smaller margin, which allows you to trade, say, 1,000 barrels of crude oil. If you take the CME crude itself, the contract size, I would say that if you trade one lot of the CME crude oil, it will be like 1,000 barrels of crude. But you need not pay the full value to trade about one contract itself. You can trade what is commonly known as margin itself, which is often much smaller. It's normally below 10% of the whole contract value itself. So most traders would trade on margin, and it also allows you a huge leverage on trading itself. So it gives you a greater exposure on crude oil itself. Okay, then we have other things that investors might need to know, in the sense that which month is the most active month. By active month, I mean because when you look at a chart earlier, all right, for backwardation, the number of months that are quoted down there, right? For example, crude oil has a number of serial months. Then we have gold also, which have the subsequent month. That means if you trade June, the next one it will take is August month. The thing is to consider which one has the most liquidity and what is your objective itself. And the thing to note about futures months are that each one has an expiration date, in the sense that they have a lifespan. So you have to be into it. Okay, so let's say I want to hold a contract for a day or a month, then which would be the best month for you to jump into? And you also have to look at the liquidity of a particular contract. And if you are a long-term investor, you might look at the further months for you to hold. And that's where you look at the trend itself and see whether, okay, it's a bull trend or it's a bad trend, and how long do you think I need to hold this particular contract? And also, if you find all these things to mind, but actually it's not to them, but for the layman, a lot of them do prefer to do what do you call the CFD, the contract for difference, which is practically quoting the spot prices rather than the future months. So you don't have to worry about, say, what the future months are being priced at. You just pay attention to the current spot price. So and there are other things that you need to know about futures itself. Primarily is that they have financial safeguards, in the sense that your counterparty is most of the time assured by the exchange itself. And on top of that, we have a number of other advantages. You have transparency in the sense that you can just on your screen at home on your brokerage account and see what crude oil is doing. And also we have tremendous liquidity in these markets, in the sense that you don't have to worry about, you want to get into a position and you want to get out of a position. There's no one else to trade with. In fact, the liquidity of these markets take care of all these things. Yeah.
Avtar, the one interesting thing that you said to me was that it's important to look at the months, because that kind of affects the way in which commodity tends to perform. So if I look at last week, what stood out for me was the price of gold, which gained 2% to hit $1,800 per ounce. So we haven't seen such a big weekly jump since last December. And there's talk that the rising tensions between the US and Russia, as well as the decline in US Treasury yields, is what's driving the gold bulls. So as this bull charges on, is now too late to start getting into gold?
When we look at gold itself, I look at gold as a function of a number of drivers. Of course, what I look at is what are the real rates, the value of the dollar, the supply-demand effect on commodities, and of course the risk. And if you look at the chart itself, you'll find that it's a beautiful chart in the sense that it gives you in a diagram what most of the variations of these four factors affect gold. And most of the time, gold movement is actually explained by any of these factors. Most of the studies by gold bulls have found that it explains over 80% of the gold movement. This time, the jump up in gold prices was because of the tensions in between the two superpowers. And that would primarily, if you look at the VIX itself, the VIX is actually index of that explains volatility. So gold moves in tandem with volatility. Whenever there is a time of uncertainty and investors are afraid, you find that gold moving up. Then, okay, but the thing that gold really moves with is real rates. We have real rates, which is defined as nominal rates after taking away the effect of inflation itself. And this time, if you look at the real rate itself, it's the reverse of the 10-year yields itself. This explains mostly the movement of gold itself. Then we have the commodity prices. Commodity prices are primarily the supply-demand factors that affect gold. If the central banks sell gold, we would have gold moving down. And if the central banks, most of the time, as it is now, as in last year also, most of them are buying gold, so we have a positive effect on gold. Then there's also the effect of the dollar itself, where the value of the dollar, in this case, it's a trade-weighted average, where the stronger the dollar, then people would rather look at the dollar itself than look at gold. These are primarily the four factors that would generally explain how gold is doing.
The question we got from a viewer was, is silver on the way up in contrast to gold?
Yes, quite interestingly, it's always, when you look at precious metals, it's always which one? Do you want to go into gold, or do you want to go into silver itself. Although both are very, very precious metals, right? The dynamics that influence them are slightly different in a sense that gold is very purely precious metal, whereas silver also has quite a number of industrial uses. Number of industries use quite a number of gold, especially now with the greening of the economy. Silver is also used in solar panels. So which one do you jump into now? These questions has often been posed itself. And you know that the general economies are moving out of COVID-19 pandemic. They're opening up slowly. Industries are picking up. Once we have some economic growth, then the people would rather look at silver rather than gold itself. Gold is very primarily safe haven. It's when there is uncertainty, people would rather go for gold rather than go for silver itself. But when in times of this, and if you're taking a very longer term view, my view is that silver would have been a better bet than gold at this current level, because countries are moving out of COVID-19. It's a matter of time that vaccinations take effect throughout the whole world. Of course, we do have pockets of areas in the world where things are not really working well. For example, in India and in Brazil. But once the nations move out of gold, there's a lot of pent-up demand for industries, especially manufactured goods and all. So, and that's where silver will come in.
Yeah, I never thought of that, Aftar. Like, I always hear that gold is the safe haven and gold is the one that investors should be investing in. So thank you for sharing about silver as well and your outlook for it. So before we end today's discussion, just maybe could you just share some tips and indicators that our viewers should look out for as they start their journey or as they continue to trade commodities in the weeks ahead?
Right. First thing, right? If you look at a commodity, you need to decide where's the trend, right? If you feel that it's the trend, it's in the bull, then you can start looking at it. One way that you can look at is, I've mentioned earlier, is the shape of the forward curve, whether it's in backwardation or in contango. They can choose the right months. Okay, what I also look at a particular commodity is the volume. The volume is primarily the number of contracts that is traded in that particular per day, or if you look at it per week or even in a month. A trend would definitely be correlated with the volume itself. If it's in a sense that if it's a strong trend, you would have volume itself that is rising. And a rising volume will tell me everybody wants to jump into that particular commodity itself. And on top of that, if you have declining volume, but the prices are going up, it sometimes gives you, I would say, a warning sign in the sense that you need to relook at the particular commodity and say, is it topping up, or is it due for retracement itself? Then I also look at the open interest. Open interest is the number of contracts that are open, let's say, overnight in a particular commodity. If the open interest is declining, it means that a lot of people do not want to be in the market when the market is closed. Whereas one that is the open interest is rising, we would find that a lot of investors want to be in the market itself. So the open interest is actually a tool that you can use to find the gauge the interest, how much people wants to be in the market itself, or they think that it's just a flash in the pan that I will just go into trade and then after that move out. All right. And I also look at what do you call the Commitment of Traders report. This report is released by the CFTC, that is the Commission of Futures Traders Commission in the US, every Friday evening. This report breaks down the open interest into a number of sectors, whether the commodity itself is being traded primarily by the funds, or is it the producers and the merchants, and is it the other traders that are too small to be reported. So this particular report breaks it down into the various sectors. Often for traders, they look at the fund positions, how the money managers are actually trading this particular commodity, and what are they rushing in to buy, or are they moving out? The thing is to look at the fund manager. Quite of them sometimes are long, and if you look at it historically, you find that sometimes even fund managers sometimes do get the markets wrong, or rather I would say the timing is not right. So everybody jumping in at the wrong time. So if you compare it with the historical fund positions, you find that if it's overbought, a lot of funds would rather take profit for the time being and wait for retracement to get back in again. Then earlier I've mentioned the stocks to used ratio. It's very important to compare the stocks to use ratio with how the stocks to used has been previously for the particular commodity. And this one, if the stocks to use ratio is declining, it means that it's primarily a bull market. And if the stocks to use ratio is high compared to the previous periods where you're looking at, it primarily means that it's primarily a bear market. So a lot of investors actually look at it, but the thing is, you got to look at it from a historical perspective of a particular commodity. For example, if you take the stocks to use ratio of, say, soya beans, it is low historically, although we have a lot of soya beans been grown in the market itself, or we have what do you call that, a lot of demand for it, and of course the inventories are also very high, but in a sense that the usage far exceeds the one that is demanded, and the ratio is quite low historically. Yeah.
Oh, Avtar, so many insights that you have shared with us. So with that, we have come to the end of this week's Brokers Digest. Thank you so much, Avtar, for sharing all your insights and tips on movements in the commodities market, as well as the signs that we can look out for when investing in these commodities. To our viewers, we hope these strategies help you in your investment decisions in the short and medium term. For more analysis on the stock market, you can visit the websites of Phillip Futures or The Edge Singapore. Do like us on Facebook and Instagram to be alerted on our next episode. We will be having another insightful session with Avtar, who will be sharing more analysis on how to trade commodities. You can also leave us a comment below if there are any questions or topics you'd like for us to discuss. I'm Amala Balakrishna. With me is Avtar Sadhu, and we'll see you again in 2 weeks. Take care. Goodbye.